Hello and welcome back to the ROI channel, the channel that's obsessed with the art and the science of return on investment. And if you're not familiar, I manage a portfolio on eToro, Crassus Investments on there. And so you can click on the link below to add us to a watch list, or if you've got funds that you want to invest with us, you can do that too and simply copy the portfolio and share in the resulting performance. Today I've got a deep dive. Okay, really excited about this particular opportunity. It's a stock analysis on a company called StoneCo. It is a fintech in Latin America, and without further ado, I'm going to take you through it and show you why I am so excited about the company. It's a long video because there's a lot to discuss, and so I'm going to get straight into it. But if you haven't already liked and subscribed to the YouTube channel, please do so. It helps me to get the message out there. Also, I enjoy the commentary, so please leave me a comment as to what you like and what you don't like about the videos, and if you want me to cover anything in particular. Crassus Investments, when I'm managing the portfolio on eToro and I'm looking for a core position, I use what I call the Crassus investment formula. And so I'm looking for companies with low debt, high margin of safety, high sales growth, strong margins, free cash flow growth in particular, my personal favorite, and ideally share buybacks. If I can get something with those, we increase our odds of getting lucky in the sense of finding an investment that will outperform over time. Okay, so if you're looking for an active manager that can provide outperformance, that's my job. That's what I'm supposed to do, and the only way I can do that is to really drill down and go into the types of detail which you are about to see in the video, should you stay awake. Okay, so quick facts on the company. Revenue, I've converted from Brazilian real to US dollars. Okay, so everything you see here is in US dollars. Revenue expected to come in at 1.3 billion. Humongous growth rate. Okay, so 48% CAGR over the last 3 years. EBITDA 654 million. Okay, so decent growth rate, decent margins there. Market cap, it's been smacked recently, so we'll talk about that. $5 billion market cap and almost the same enterprise value. Okay, so relatively little debt on that one. The price at time of recording, $16.35 with 309 million shares outstanding. Now, just on the shares, they did some dilutions in 17 and 18. They actually bought and made some acquisitions. They did buy back $200 million worth in the first half of 2021. So the management are looking to do the right thing by shareholders and start to pay them back. In this case, share buybacks makes a great deal of sense given the low debt and given the dilutions. And return on invested capital is roughly 9%, which is reasonable and pretty good, but I think that they'll be able to improve that over time. They're in a growth phase, and so they're looking to acquire platforms, and then they'll integrate their business. And when they go through the integration stage is where you'll see that number start to rise should they be successful. Net debt to EBITDA is not currently an issue at well less than 3 times, and it's only 0.19 times. Here's where you look at the market cap. Okay, the price action over the year has gone from just south of 100 US dollars down all the way to $16. So it's been smacked 68%, and that, I believe, is a little bit of a trick. I think people are getting a little bit tricked on that one because they entered into an acquisition and the valuation soared from the companies that they had bought, and then obviously stock markets rise and fall, and so Brazil's struggling a little bit with the COVID scenario. Their investment was marked down, and so that was entered as a non-cash loss, and there was very little mercy in terms of the share price sell-off. And whenever we see that, our antenna just sort of go up a little bit. It might be a rubbish company, we may pass. We don't just buy something because it's fallen by 68% on the year, but it just makes us take a look. Okay, now I'm really interested in this company. If we go back to its IPO, you'll see there Berkshire Hathaway participated in the IPO. They do not normally do that. They also do not normally buy companies with negative cash flow, which at the time, a StoneCo was both of those. It ticked both of those boxes. Had negative cash flow, and Berkshire bought in at around, I believe the IPO was $24. Okay, so if you believe in the ability of Warren Buffett and Charlie Munger to pick good stocks, then that might be of interest to you, just to give you a bit of a guide as to where they entered. And as long as nothing adversely has changed in terms of the business fundamentals, that will suggest for us getting in at around $16 is is a bit of a bargain. But we need to go and do a bit of a deeper dive. So here are some key points. It's a Brazilian fintech, okay? Brazil's the largest country in Latin America, so very, very important economically, geopolitically also, a very commodity-sensitive economy. Now, their services, it's a brick, not Brock. I'm not a New Zealander, I'm Australian. It's a typo there. Their fintech services primarily local merchants, okay, so they haven't scaled really too far outside of Brazil. Local brick and mortar merchants, so your coffee shops, mum and dad type small to medium enterprises, of which 652,600 clients are on their books, 260 globally integrated partners, okay, so their partners are where they can have access to a whole host of different potentially new customers. And so where the market is unhappy are the errors in its acquisition of Banco Inter. They deem that a poor acquisition. Don't know why, in the sense that when Banco Inter was performing well, they seemed to love it, and then it had a bad quarter and bad half of the year, and they had a non-cash write-down. So anyway, stock price fell 68%. When we're looking at this, what are the main investment theses or the main tenets that make up our investment thesis for the particular company? And for this, it's reasonably simple. Okay, we're looking at what are in my opinion, I can see three big growth drivers for StoneCo. One is inflation. Now, if you've watched my video on Fiserv, same deal applies. Okay, Fiserv operates in the US mainly, but their payment processing is where they're expecting to make most of their money. If you have a company like a PayPal, a Square, a Fiserv, StoneCo, they will clip the ticket, so to speak. So they will take a small percentage of all the transactions. So if you have inflation, which Latin America seems to have all the time anyway, and globally we're expecting a much higher inflationary environment, then we would expect the nominal prices of goods and services to rise. So their earnings will be reported higher based purely off the inflated nominal prices of the transaction. Another thing that people don't often think about is the behavioral adaptation when you're in an inflationary environment. So if you know goods and services are going to be more expensive, you buy them when you can. So you front load your investment or your consumption. If you know your groceries next month are going to be 6% more expensive, well, why not buy twice as many groceries this month and try and hold off if you can. So not only will the prices start to rise, but potentially, depending on consumer sentiment, the transaction volume may also increase. And so that will obviously be bullish for StoneCo, as they'll be clipping the ticket. Latin American economy is another growth tenet. So do we believe that Latin America is going to do well in the coming 5 to 10 years, let's call it? I personally do. I think that there are a lot of people that are fed up with the US. Latin America's next door. Cost of living is cheap. We're going to be moving into, or we are already moved into a bull market for commodities, in my opinion. And Latin America, particularly Brazil, if you watch a video on Vale, is an important player with global commodity suppliers, because they can produce particularly iron ore, but also copper and gold, silver, and so on and so forth. The third main aspect is, can they pull off good acquisitions? Okay, so their growth rate has been phenomenal. Their runway is looking good. When they start to make their acquisitions, as long as they're not horrendous, they should be able to come up with synergies between each of the new businesses that they acquire, and they'll be able to move out a lot of excess costs. That will be so bullish for the company, because when they do, when you've got 48% revenue growth, some organic and some from acquisitions, you're taking out a lot of the costs. All of a sudden, your free cash flow conversion will start to go through the roof. So instead of spending money on buying more money, on buying more cash flows, they'll take out a lot of expenses and hand that back to the shareholders. Their free cash flow will be what will be left after their tax has been filed and expenses been paid, will be available to shareholders, and that amount will continue to grow. So they can buy back stock, they can pay dividends, so on and so forth. The recent earnings and the KPI update. So there's been a lot of volatility. We want to make sure, okay, what's the thesis and how are we going to measure it? So we've got our narrative. How are we going to know if reality stacks up to the narrative? And the answer is, we need our arithmetic or our measurements to support what we think is going to happen. So StoneCo, as I mentioned, they bought almost 5% of Banco Inter. The stock appreciated, okay, so that they were doing really well. 841 million reais it would increase. So on their books, that was marked up. So it looked like they were making a huge profit. Unfortunately, markets go both ways. So it tanked down. And as far as I can work out, this is a non-cash write-down of 1.2 billion Brazilian reais. That, it will show up on the earnings. And so obviously that will, with investors paying multiples of the earnings, that will depress the stock price. But it may not be such a big deal. Something to take, when I say big deal, it might be overblown in terms that's not cash that has been taken out of their pocket and completely burnt up. As long as they don't crystallize the loss, which they may have, then it's a full write down. Then don't forget that the investment can come back, and so then being marked to market higher, the value of their investment on their books will also increase StoneCo's book value. This is something that I talk about all the time, and that is the discrepancy between the EBITDA, earnings, and free cash flow. So if you have a non-cash write-down, you can easily have that's significant, and in this case, 1.2 billion will be. Their free cash flow can easily be a lot higher than their earnings, okay? And so it's just something to keep in mind. If you're just doing what a lot of investors do and just use earnings and earnings multiple, or the PE, you may be missing out on great opportunities because it looks like the earnings are very, very low, but they're held down artificially because all those non-cash costs are calculated in the earnings, but not in the EBITDA or in the free cash flow. So if you use the free cash flow, generally speaking, you're getting a more accurate picture of the performance of the business, the amount of cash that you can take home and spend, okay? And that's what you want to know. They did make smaller acquisitions. They're trying to reach out into your credit market, and the idea there is that if they lend to small businesses, they'll be able to cross-pollinate their lists and cross-sell. So if you're lending to an SME in Brazil, and they might have a sales process where they say, hey, what sales point of sale system are you using? Oh, well, why don't you use StoneCo's PagSeguro, I think, is what they use. So like Fiserv have the Clover platform, StoneCo use PagSeguro, which just means pay safe, and so that they'll be able to convert customers and have one business feed into the other, which is a good idea as long as they can make it work. But don't forget, lending is an inherently fragile business, and when you're in that Latin American economy, inflation can start to take a hold, as I've mentioned. That can be good if you're clipping the ticket, bad if, generally speaking, if you're a lender, because initially it seems good because you can raise your interest rates and your yield curve starts to increase, but you end up getting to a point where the debtor can no longer repay the creditor. So if you've lent money out to a local business and interest rates rise in lockstep with inflation, that seems good for you because you're making more margin, but you hit this tipping point where the poor old business to which you've loaned the money, they say, look, we can no longer repay you because our costs have inflated more than we can offset with the prices of our goods that we sell, and our interest rates are killing us. So you'll see that an increase in the default rates as a percentage of their loan book will start to increase, and that will make the market a little bit worried, and justifiably. Most of the losses, as I mentioned, seem to be non-cash, marked to market for accounting purposes, and I think the sentiment is probably overly negative in that regard. This will also keep their earnings reported lower into next year and the year after if they do happen to write them down. So looking at free cash flow becomes all the more important from my point of view. Okay, so well, why do you think that, Ben? Everyone else thinks that the company's in a lot of strife and they've sold off 68%. It's a good question, one that we have to answer fairly thoroughly. The revenue numbers. So revenue, 1.47 billion Brazilian reais. Reais, I think is how you say it. Someone will correct me in the comments. $270 million worth. That's up 57% year on year. So huge growth. I mean, in the middle of a pandemic, if you don't mind, that's phenomenal. The fintech company reported 1.26 billion net loss due to a write-down of the fair value of their investments. So that was talking about the Banco Inter investment before. But if you take that out, and this is key, so if you exclude the non-cash items, adjusted net income for Q3 was positive. Okay, so they were making money off their core business. They just need to stop stuffing around and buying out these other questionable acquisitions. 133 million reais, which is about 24.1 million. So for the quarter, about $100 million US. That's a lot of money in Brazil. Okay, so that is significant. Active payment customers increased 111% to 1.39 million as of the end of the third quarter. And here's the thing: these customers are sticky. So once the SME in Brazil, they take out their PagSeguro and they're happy and so on and so forth, they're not likely to change. And so if you're seeing the customer adoption rate increase, this is part of the reason why their growth rate has been so good and why investors up until recently were willing to pay huge multiples for a Latin American fintech. Because as I mentioned earlier, you've got this narrative. What are we going to measure to make sure that reality is matching up with our narrative? And customer acquisition is a huge, huge deal in terms of measurements to follow. So that is good. We want to see more and more customers adopt their services and their platforms, and obviously reduced attrition rate. We don't want them to drop off. But that is one of the key ones, because we know they've got a great margin. So if their margins are staying the same, we want to see, are they adopting more and more customers quarter on quarter, year on year. The company continues to invest heavily to attract merchants to its platform and made another investment in Gira Plus, a small fintech company that specializes in loans to small business. Stop doing that. Okay, stop it. Just instead of going out and buying businesses to ransack their customers to get them back onto your original core platform, your core business, which is doing very well, don't take on the risk of buying up these loan books in Latin America where you can have a huge default rate. Leave that alone and instead spend that money on just marketing your core product. Okay, that would be my advice to management. I would far prefer to see them do that than getting into the microfinance. It's doing well, okay, and you'll see in the numbers, it's working well and it's cross-pollinating, but I don't think they need to do that. They're taking on more risk than they need to. Go and buy out your competitor. If you're obsessed with buying out other companies, go and buy out your competitor, roll them up, synergize, one lot of SG&A expenses, one website, one lot of marketing, one brand, and do it that way, as opposed to branching out too far and having too many different things. Anyway, the growth factor is high, okay? So if we take a look at the macro or mesoeconomic picture, JP Morgan have estimated e-commerce in LATAM to grow at about a 9% CAGR into 2023, and I think that's understated. I think it will grow, and here's why. So 72% of the population still hasn't made an online payment in Brazil. Okay, so we forget about that over here in the Western world, because I'm in Australia, it's technically the Eastern Hemisphere, but the developed world where we're all into the online payments and the e-commerce, we forget that there are parts of the world that haven't yet had that adoption. So if you take 150 million Brazilian citizens with internet access, I think there's 280 million is the population of Brazil, it might be closer to 300. 68% of them have a smartphone. So you've still got a huge percentage of the population that will inevitably get a smartphone. They'll inevitably get internet access. And of course, inevitably, it follows that they will start buying and selling things online. You've got this humongous runway for growth. 4 million new e-customers were brought online during COVID. So COVID just enhanced the adoption rate around the world for e-commerce, because bricks and mortar was basically locked down. The thing that weighs the adoption rate down at the moment is the internet speed. Okay, so Brazil can get its act together in terms of its infrastructure and internet speed. Holy moly, we may have a blow off top in terms of the growth and adoption rate. So here we go, 211 million. There you go, 211 million registered population, and you've got a fairly young average age there. So this is good for economic prospects moving forward. 1.8 trillion GDP, and the e-commerce value, there it is, at just under 24 billion. Okay, so the internet still has a long way to go to penetrate close to 100%. Same deal with smartphone and even bank accounts. Okay, opening up a bank account and bank cards, it's just amazing. And when you look at these statistics, here you've got the quarter-on-quarter growth for the percentage of payments that were made via card in Brazil. Okay, so look at the growth and adoption rate. And if you're using your card and you're tapping, and you're using a point of sale, a huge amount of those are going to be point of sale systems that are owned by StoneCo. So they're getting a clip every single time, which is why it's got me so excited. If you look at the client books, here are the active client in terms of payments in the thousands, going back from the first quarter of 2018. The runway is huge. Okay, it looks like one of those escalators going up a level or two at your local mall. And if you look at the year-on-year or quarter-on-quarter over the last year, 34.5% growth, phenomenal. Okay, and then if you look at the volume payment amounts, you can see over here on the right, things are heading in the right direction there also, when you take into account Corona. So the Corona voucher were issued, I believe, by the Brazilian government, and so obviously you wouldn't take that into consideration normally, and so they've changed that. They've put that in the lighter green color there. Okay, so here's where they want to get to, and this is why they're messing around buying out all these other credit businesses. So they're currently here, they're a payment platform and business owners organizer, for want of a better word. So I'd imagine you can do your bookkeeping, and here's your KPI dashboard for Pagar.me, so pay me. And then you've got your PagSeguro, which is the payment processing, the POS terminals. So you've got a little bit of hardware, mainly software, which is why they keep their margins quite healthy. In the future, they want the whole box and dice. Okay, so anything to do with money moving anywhere, they want to be involved. So POS terminals, they've got. They want to have wire transfers, so they can take a clip of the ticket. So if they own banks and credit facilities and so on, they can have bank accounts and charge fees. So on and so forth. Okay, online sales, reconciliation. They'll be doing things like Afterpay that everyone knows about here in Australia. They'll have all these different weird and wonderful solutions, and they'll be fully integrated across the board. Okay, and so it's a promising narrative and picture moving forward. But Brazil's Brazil, so you do have to have a discount factor. Love Brazil and love the people, and you just got to take into account that things always look good in Brazil. They always do, and they always have. Brazil's the country of the future, always has been, always will be, as the Brazilians themselves say. So you just got to count a discount for an emerging market economy. Here you've got the revenues. Okay, so just to illustrate the CAGRs of 48% there, it's taking off like a rocket, and I believe it will continue to do so. Here's a trick when you're looking at the valuation. So that's the key points, the company fundamentals, the mesoeconomic overview. What do we value the company at, and what do we pay for it? They're the next question. So if you look at the competitors here on my software, it's not an accurate apples for apples comparison. So Adyen is a great payment processor over in Europe, completely irrelevant and inappropriate company with which to compare StoneCo. Even PayPal, okay? StoneCo is not PayPal. So we need to find some other guys that are more appropriate comparisons. So PagSeguro Digital and Cielo SA would be the next ones. So you can't just go down and use the median, because that will be skewed. Look at the median market cap to cash flow, 112 times for Adyen, okay? I don't think we'll see the day where someone will pay 112 times for the cash flow of a Latin American fintech. Maybe they'll pay up towards 30, but that would be a huge stretch, okay? So you just need to take that in mind. What I've done when using my multiples, I've taken out the companies that are irrelevant, and then I've used the median of the companies that are left over, so the Brazilian companies that are left. And when you do that, what do we get? So looking out to 2023, free cash flow, EBITDA, and earnings per share expected. Look at the difference between them. And this is because the earnings, as I say millions of times, takes into account non-cash items, okay? This is good in terms of the company. They can write down stuff and it helps for their tax purposes, but you want to know what cash you can take out of the business that's available for further reinvestment. The multiples I've used stand as such, and so here you can see the implied prices. If we take an equally weighted average, we might expect reasonably a $24.16 price moving it towards the end of 2023 if we don't get multiple expansion from here, which we could. So conservatively, we could be looking at a 47% increase on the upside for a fantastic company with a strong balance sheet that has its fingers in all sorts of different pies across Latin America, and that has 48% CAGR revenue growth. So huge opportunity, okay? Take things out a step further. Let's be conservative, but let's look out over the next decade using these growth rates, using a base, a bull, and a bear case, and assigning the probability weightings that you can see down here in the bottom table, shaded in gray. I do that for EBITDA, free cash flow, and earnings. Earnings brings it all the way down. So if you wanted to, you could get rid of the earnings and take a look at just the cash. But to be conservative, I use it as part of an equally weighted average. And I say to myself, applying a discount of 20%, I want a huge margin of safety because there are risks, particularly in Brazil, corruption and so on and so forth. What is the business worth, and what would I be willing to pay for it? So the intrinsic value of the business, if you want to average a 20% a compounded annualized rate of return over time, and you believe everything that I put into this table here, we would expect the business to be worth somewhere around $25.58. We apply a margin of safety, even though we've been conservative, and if we can buy the business at $16.88, which is 2/3 of that intrinsic value, then we would be very keen to start loading up on the position. And that is where we're at today. We're around about $16. And so if you're like me and you like the company, now's the time to start to buy, in my opinion. Okay, obviously it's not a recommendation. You have to be responsible for your own decisions. But for me, I'm looking at it quite favorably. So we say, okay, EBITDA and cash flow on a per share basis. If we pay the price today, following the cursor there, and we're expecting to get these cash flow streams over time, exit multiple, discounting it back at the cost of capital, what will that be as an internal rate of return? Okay, so annualized rate of return, for want of a better word, and we're getting a 40% IRR. 40% is a humongous IRR, and we're interested in that. Okay, so we'd be happy with 20. If we can get 40, we're doubling our money in less than 2 years, provided everything plays out as we've listed here. Here we've got, again, same deal, but using the free cash flow alone as a metric, discounted at the cost of capital. We're getting a suggested IRR of 25%. Okay, so you average between the two, we're going to get a market-beating IRR in most cases, and perhaps unsurprisingly, my verdict is a buy. I am buying it for the portfolio. I'm going to enter into about 1% of asset under management. The question I have is I would like now to actually reduce the number of positions in the portfolio and become more concentrated. The overall market, notwithstanding the recent sell-off, I still think is quite concentrated and there's concentration risk. I would prefer to focus in on the value plays and bring the overall positions down to around 30 to 33. We're currently at 34. I would like to, in an ideal world, just pick one of the fintech plays that we have. So we have Fiserv and we have now StoneCo, and unfortunately, because they operate in different markets and I have to apply a risk factor to Latin America, I kind of want to keep them both. And this is the problem that I'm having also for the discussion between Kirkland Lake and Barrick Gold, and the discussion between Synovus and Ovintiv and the oil play. I'm finding it difficult. I like all our positions so much. I don't know which ones I want to cull, which is obviously a good thing. But I'm scaling into 1% asset under management. It may grow out to as large as 2 to 3%, depending on what happens for valuations here on in. If Fiserv runs and StoneCo still has a bit of a stigma, I may sell, take the profits, and roll it into StoneCo. We'll see. Thanks for watching, guys. I know it's a long one, but there was a lot to cover, and I really, really wanted to give a good representation of this business. If you haven't already downloaded the eToro app, even just to take a look and add us to a watch list. If you have some funds and you'd like to share in the gains from the portfolio that I manage, just click on the link in the description and copy open trades. So you add your funds, you press copy open trades, bang, you're done. You can withdraw it whenever you want to, guys, okay? So if you think that that's the right decision for you, keep that in mind. That's how you do it. And if you haven't already liked and subscribed to the YouTube channel, I would greatly appreciate you doing that. And I'm going to leave it there because this is a long one. Thank you very much for watching. Disclaimer, everything that I've said here is just my own personal opinion. And just because I believe in something doesn't mean that it's right or wrong, and doesn't mean that it's right or wrong for you. I don't know your situation. I'm not your financial advisor. So please make sure you take that into account. And remember that everything is for entertainment and educational purposes only. None of this is specific advice or advice at all. Having said that, make sure you do your own due diligence on any investment and make up your own mind. Take responsibility for your own decisions. And if you've got a comment, leave it in the comment section. Otherwise, I wish you all the best, and I'll catch up with you in another video.